You wake up in the morning. You buy coffee. You check your bank account. You worry about rent. You think about your future. And without realizing it, economics has already touched every one of those moments. Not through textbooks, not through equations, but through prices, wages, interest rates, and fear. Today, we're going to slow things down and look at the economic ideas that quietly shape modern life, not as theory, but as something deeply human. Inflation is not just rising prices. Inflation is time stealing from money. Imagine earning the same salary for 5 years. Nothing changes on paper. But every year, your money buys less food, less comfort, less security. That silent erosion is inflation. It usually begins when too much money enters the system, or when production can't keep up with demand. Inflation doesn't feel dramatic at first. It feels normal. Until one day, you realize the future you planned now costs more than you can afford. Why does something suddenly become expensive? Because value is not fixed. It's negotiated every second. Supply is what exists. Demand is what people want. When many people want something that barely exists, price becomes a gatekeeper. This is why rare things feel valuable and common things feel cheap. Markets are not emotional, but they react to human emotion constantly. Fear, excitement, panic, desire, all translated into numbers. GDP is often treated like a nation's heartbeat. When it rises, headlines celebrate. When it falls, panic spreads. But GDP only measures activity, not meaning. It counts production, spending, and output. But it does not ask who benefits or who struggles. An economy can grow while people feel poorer. GDP tells us how fast the machine is moving, not who the machine is serving. Interest is the cost of borrowing time. Low interest rates invite risk. They encourage spending, investing, expansion. High interest rates create hesitation. They slow movement. They punish debt. Central banks adjust interest rates like a pilot adjusting altitude. Too fast, the system overheats. Too slow, it stalls. Most people never see this control panel, but they feel its effects everywhere. A recession is when confidence disappears. People stop spending not because they want to, but because they're afraid. Businesses stop hiring. Investments freeze. Uncertainty spreads faster than facts. Recessions are not failures of individuals. They are systemic pauses, painful, necessary, and always unequal. Unemployment is more than a statistic. It's the distance between effort and opportunity. It means waking up without purpose. It means skills losing value. It means time becoming heavy. Even healthy economies can leave people behind. Technology moves faster than adaptation. Markets reward efficiency, not fairness. Behind every unemployment number is a life waiting to restart. Central banks are quiet institutions with enormous power. They decide how much money exists, how expensive it is to borrow, and how stable the system feels. They don't control outcomes. They influence conditions. When they act too slowly, inflation escapes. When they act too aggressively, growth suffocates. Their greatest challenge is timing. Money works because belief works. Modern currency has no physical anchor, no gold, no promise of conversion, only trust. When trust remains, money flows. When trust breaks, money runs. Currency crises are not financial events. They are psychological collapses. A deficit is spending tomorrow's resources today. Sometimes it builds roads, schools, futures. Sometimes it builds illusions. Deficits are powerful tools, but dangerous habits. What matters is not borrowing, but whether borrowing creates value or postpones collapse. Debt is hope with a deadline. It allows progress before resources exist, but it demands discipline afterward. Debt does not disappear. It waits. Economies grow by managing debt wisely. They fall by ignoring its limits. Capitalism is an economic system built on ownership and incentive. People own property. People invest capital. And people take risks in exchange for profit. At its best, capitalism rewards innovation. It turns ideas into industries. It lifts entire societies out of poverty. But capitalism has no moral compass. It does not care about equality. It does not care about stability. It only responds to incentives. Left completely unchecked, capitalism concentrates wealth, amplifies inequality, and turns survival into competition. Capitalism is powerful, but it needs rules, or it consumes itself. Economic inequality is not accidental. It is the natural outcome of compounding advantage. If you have assets, they grow. If you don't, you rely on labor. And labor has limits. Time has limits. The day has only 24 hours. Wealth, however, works while you sleep. Inequality grows slowly, then suddenly. Not because people are lazy, but because systems reward position more than effort. The market is often described as neutral. It isn't. Markets reward what is profitable, not what is necessary. Healthcare, housing, and education are essential for survival. But markets treat them like commodities. This creates tension. When human needs meet profit incentives, someone always pays more than money. Markets are efficient, but efficiency is not the same as justice. A bubble forms when belief replaces value. People stop asking, "What is this worth?" and start asking, "What will someone else pay for it?" Prices rise not because of fundamentals, but because of expectation. Everyone knows it can't last. But no one wants to be the first to leave. Until reality arrives. Bubbles don't burst quietly. They collapse violently, taking trust with them. Financial crises are not surprises. They are warnings ignored. They begin with optimism, accelerate with leverage, and end with panic. Risk spreads quietly through systems designed to hide it. When confidence breaks, liquidity disappears, and institutions that once seemed immortal collapse overnight. Crises reveal one brutal truth. The system is only stable as long as people believe it is. Globalization connected the world's economies. Production moved where labor was cheap. Consumption stayed where money was strong. Prices dropped. Efficiency increased. But stability weakened. Supply chains stretched across continents. Local jobs disappeared. Entire regions became dependent on distant decisions. Globalization created growth and fragility. Power in economics is the ability to influence outcomes without being visible. Corporations shape markets. Financial institutions shape policy. Capital moves faster than democracy. Those who control resources rarely need to explain themselves. Power doesn't announce itself. It hides in complexity. Systemic risk is danger that cannot be isolated. When systems are interconnected, failure spreads. One bank falls, another follows, then another. Modern economies are efficient, but tightly coupled. This makes them fast and fragile. Every economic decision has a cost. If prices stay low, someone earns less. If profits stay high, someone works harder. If debt grows, the future pays. Economics is about trade-offs, not solutions. The question is never, is this free? The question is always, who pays? Money is not value. Money is a claim on value, a piece of paper, a number on a screen, a promise that says, this can be exchanged for something real. Modern money has no physical anchor, no gold, no fixed limit. It works because everyone agrees to believe in it, together. The moment that shared belief weakens, money starts losing its power. Not instantly, gradually, quietly. Most people think banks lend existing money. They don't. Banks create money when they issue loans. When a bank approves a loan, it doesn't hand you someone else's savings. It creates new money, digitally. This means most money in the economy is born as debt. As long as loans are repaid, the system feels stable. But when confidence falls and loans stop being repaid, the system tightens. Money doesn't disappear dramatically. It simply stops moving. Banks only keep a fraction of deposited money in reserve. The rest is lent out. This system allows economies to grow faster, but it also creates vulnerability. If too many people demand their money at once, the bank cannot provide it. This is called a bank run, and it doesn't require logic, only fear. Inflation becomes dangerous when it feeds on itself. Prices rise. People expect prices to rise more, so they spend faster. Businesses raise prices preemptively. Workers demand higher wages. Costs rise again. The cycle accelerates. At this point, inflation is no longer economic. It's psychological. Breaking an inflation spiral requires pain, higher interest rates, lower spending, unemployment. There is no gentle exit. Hyperinflation is the death of money. When trust collapses completely, currency becomes meaningless. Prices change daily, then hourly, then constantly. People stop saving, stop planning, stop trusting institutions. Money turns into something you escape from, not store. History shows the same pattern every time. Massive money creation, political instability, and lost credibility. Hyperinflation doesn't just destroy economies, it destroys social order. Debt works until it doesn't. As long as future growth is expected, debt feels manageable. But when growth slows, debt becomes a weight. Governments borrow to delay pain. Companies borrow to survive. Households borrow to maintain lifestyles. Eventually, the future arrives, and it sends the bill. Financial panic spreads faster than facts. Markets don't crash because numbers change. They crash because confidence disappears. Selling feeds selling. Fear feeds fear. Institutions that looked strong yesterday become fragile overnight. Panic reveals something uncomfortable. Markets are rational until humans aren't. Economic collapse is rarely sudden. It begins with denial, then distortion, then intervention. Rules are bent, data is adjusted, reality is postponed, until it can't be anymore. Collapse is not the moment everything breaks. It's the moment belief finally catches up to reality. Despite everything, economic systems rarely disappear completely. They transform. New rules replace old ones. New currencies emerge. New power structures form. Collapse is destruction, but also reorganization. The question is not if systems change, it's who pays during the transition. Cash is freedom in physical form. It doesn't ask who you are. It doesn't record where you've been. It doesn't care what you buy. That's why it's disappearing. Digital payments are faster, cheaper, more efficient. But efficiency always comes with visibility. When cash disappears, every transaction leaves a trace. Convenience increases. Privacy fades. Digital money is not neutral. Unlike cash, digital money can be programmed. It can expire, it can be limited, it can be approved or denied. This changes the nature of money itself. Money stops being a passive tool and becomes an active system. Not just something you own, but something that governs you. CBDCs are government-issued digital money. On the surface, they promise stability and efficiency. But underneath, they introduce something new: control at scale. A CBDC can track spending in real time. It can enforce rules automatically. It can shape behavior instantly. This is not inherently evil, but it is historically unprecedented. For the first time, money and policy can merge into one system. AI doesn't sleep. It doesn't panic. It doesn't hesitate. AI already trades markets faster than humans, approves loans, detects fraud, optimizes pricing. In the future, AI won't just assist financial decisions. It will make them. Efficiency will improve. Errors will drop. But accountability becomes unclear. When an algorithm decides your access to money, who do you argue with? Cryptocurrency was born from distrust. Distrust in banks, distrust in governments, distrust in centralized power. It promised independence, transparency, mathematical rules instead of human discretion. But freedom has a cost: volatility, complexity, speculation. Crypto revealed something important. People don't just want better money. They want fairer systems. Every financial system balances two forces: freedom and control. Too much freedom. Instability grows. Too much control. Trust erodes. Digital money pushes the balance toward control. The question is not whether this will happen. The question is how far it will go before people resist. Not technology. Not governments alone. The future of money is shaped by acceptance, what people tolerate, what they normalize, what they trade for convenience. Money evolves when behavior evolves. The future of money is not about coins or code. It's about choice. Will money remain a tool that serves people, or will it become a system that people must serve? Economics is not destiny, it's design. And every design reflects values. The systems we build will shape the lives we live. Understanding them doesn't make you powerful, but it makes you aware. And awareness is the beginning of choice. If this series helped you see the system more clearly, like the video, subscribe to Anything Explained, and keep questioning the invisible forces that shape your world. Because complex things don't need to control us once we understand them.